Liquidity is vanishing, and the reason that matters is simple. In modern markets, liquidity is the invisible permission slip that allows everyone to stay leveraged, stay invested, and stay calm. When that permission gets revoked, price doesn't move because the world suddenly learned new facts. Price moves because the system's ability to finance itself gets tighter. That is what repo market stress really is. It's not a vibe, it's a funding constraint. Most people treat repo like a technical footnote, something only bond traders discuss. But repo is the daily heartbeat of Wall Street. It is how enormous positions in Treasuries are funded. It is how leveraged trades are kept alive. It is how dealers hold inventory and provide liquidity. And when repo stress spikes, it's the market telling you that cash has become scarce, that balance sheets are tightening, and that someone is being forced to reduce risk. This is why liquidity events feel sudden and unfair. They are mechanical. They don't care about your thesis. They don't care that your long-term view is right. They care whether you can fund your position today. And when funding gets expensive, markets don't ask for your opinion. They ask for your collateral. So in this breakdown, we're going to do something that most commentary doesn't do. We're going to separate the story layer from the plumbing layer, because the story layer can sound convincing, while the plumbing is failing underneath it. We'll explain what repo is in plain English, what it means when repo stress hits a new spike, why Wall Street reacts so aggressively to what looks like a small change in rates, and what signals tell you whether this is a one-day scare or a broader liquidity squeeze. If you only remember one line from today, remember this: the price of money sets the price of everything else. Repo is where the price of money shows up first. Repo stands for repurchase agreement. At its core, it's a short-term loan secured by collateral. One party needs cash, another party has cash. The borrower hands over collateral, usually US Treasuries, and receives cash. Then the borrower agrees to repurchase that collateral later at a slightly higher price. The difference between those two prices is effectively the interest rate. That's it. Cash against collateral. Often overnight, sometimes term. Because it's collateralized by Treasuries, it's supposed to be safe, routine, and cheap. But here's what makes repo powerful. It's not about one loan. It's about the entire network. Dealers finance Treasury inventories in repo. Hedge funds finance relative value trades in repo. Money market funds lend cash into repo as a way to earn short-term yield. Banks use repo to manage liquidity. Repo is the market where a huge portion of the system's leverage gets rolled over day after day. So what does it mean when repo stress spikes? It means the cost of obtaining cash against collateral rises, or the ability to obtain it becomes restricted. It can show up in several ways. The most visible is rate spikes. If repo rates jump, it suggests that cash is in higher demand or lower supply. But rate spikes alone don't tell the full story. The second sign is haircuts increasing. A haircut is the discount applied to collateral. If you want to borrow cash, you might have to post more collateral than before. That's the lender saying, I want more protection. Higher haircuts force borrowers to either find more collateral or reduce positions. Either way, they reduce leverage. The third sign is collateral becoming special. Sometimes, certain Treasury issues become so desired that borrowers are willing to accept a lower rate just to obtain that specific collateral. That specialness indicates scarcity of high-quality collateral in the right place, or a market that is becoming defensive and choosy. The fourth sign is counterparty selectivity. Lenders might step back from lending to certain borrowers, not because they lack cash, but because they want less exposure. The market shifts from anyone can borrow cheaply to only certain names can borrow comfortably. That shift is where panic starts, because the system depends on broad access to funding. Now, why does a repo spike matter so much? Because it forces deleveraging. And deleveraging is the most underrated driver of violent price moves. Think of leverage as a set of stacked promises. Promises that positions can be financed. Promises that collateral will be accepted. Promises that rates will stay within a manageable range. When repo stress spikes, those promises get repriced. The cost of maintaining leverage rises. The system responds by shrinking positions, selling assets, and hoarding liquidity. This is why you can see markets move sharply without any major news. Funding is the news. Funding is the shock. Here's an example that makes it real. Consider a hedge fund running a low-risk relative value trade in Treasuries. It buys cash Treasuries and shorts Treasury futures, capturing a small difference. It seems safe because it's hedged. But the spread is small, so the fund uses leverage to make the returns meaningful. That leverage is financed through repo. If repo rates rise or haircuts increase, the fund's funding cost rises and the required collateral increases. The trade may no longer work. The fund must unwind. Unwinding means selling Treasuries. If enough funds unwind simultaneously, Treasury prices can move abruptly. Market depth can vanish and volatility rises. Treasury volatility then spills into mortgages, corporate bonds, equities, and credit, because Treasuries are the benchmark for the risk-free rate. This is why the repo market is not separate from the market. Repo is the market's financing layer. When the financing layer tightens, the asset layer shakes. Now add dealer behavior. Dealers are supposed to provide liquidity by holding inventory in making markets, especially in treasuries. But dealers have finite balance sheets and regulatory constraints. When funding tightens, they conserve balance sheet space, they reduce inventory, they widen bid-ask spreads, they provide less market depth. That makes price moves more violent. Violent moves increase perceived risk. Perceived risk tightens funding further. The feedback loop intensifies. That's what a liquidity crack looks like. Not one explosion, but a system that becomes less willing to absorb stress. So why would repo stress spike now? There are multiple catalysts, but the real answer is always some version of this. Too much demand for cash relative to the system's willingness to supply it. One cause is reserve scarcity. Bank reserves are the settlement balances banks hold at the Federal Reserve. When reserves are abundant, banks are more willing to lend into repo markets. When reserves are tight, banks become cautious. They prioritize their own liquidity needs. They lend less. Rates rise. Reserve scarcity can happen during quantitative tightening when the Fed drains liquidity. It can happen when Treasury issuance pulls cash out of the system as investors pay for new bonds. It can happen when cash piles up in places that don't transmit liquidity efficiently, like certain money market structures. It can also happen when regulatory constraints make banks reluctant to expand balance sheets. Another cause is calendar effects. Quarter-end and year-end reporting can change behavior. Banks manage balance sheets to meet regulatory requirements and ratios. They might reduce repo lending temporarily. If demand for cash remains, rates spike. That kind of stress can be transient, which is why persistence matters. Another cause is collateral dynamics. Massive Treasury issuance means more collateral must be financed. Dealers take down supply, but that supply must be funded. If funding is constrained, dealers demand higher yields or reduce liquidity provision. This can cause Treasury market volatility. Treasury volatility is a system-wide problem because Treasuries are the core collateral asset used for financing and risk management. Another cause is risk perception. If volatility increases, lenders demand higher haircuts. If a big player is rumored to be under stress, counterparties step back. If markets begin to fear a chain reaction, everyone becomes defensive. Liquidity becomes selective. Selective liquidity is the early stage of a freeze. Now, here is the piece most people miss. A repo stress spike is often not about one bad asset. It's about the system reaching its leverage limit. When the system is calm, leverage builds quietly. Strategies that rely on stable funding become crowded. The market becomes dependent on low volatility. Then, a small change in funding costs or collateral availability triggers unwinds. This is why liquidity events often feel like they come out of nowhere. They don't. The buildup is just invisible, like pressure behind a wall. Now, what happens across markets when liquidity starts vanishing? Phase one is the scramble for cash. In a scramble, participants sell what they can, not what they want. This is why safe assets can get sold initially. Gold can get sold to meet margin needs. Treasury positions can get sold if funds are unwinding. Equities can drop because risk budgets are being cut. Credit spreads widen because liquidity premiums rise. Correlations go up because everything becomes part of the same funding problem. Phase two depends on the policy response. If the Fed injects liquidity, if it signals support for market functioning, if it slows or reverses tightening, the system can stabilize. Markets then shift from sell for cash to buy hard assets because the response is inflationary or supportive. That's why gold can sell off in the first phase and rally in the second. The sequence is mechanical. But you cannot assume phase two arrives quickly or cleanly. The market can whip around. It can bounce and then drop again. It can punish anyone who thinks one day resolves the story. So when we say liquidity is vanishing, the question is it a momentary spike or a trend? The answer lies in the signal behavior. If repo rates spike and then normalize, if haircuts remain stable, if Treasury market depth recovers, and if the dollar stops surging, then stress may be contained. If rates remain elevated, if haircuts rise, if collateral stays special, if Treasury market liquidity remains thin, and if the Fed's tone shifts toward monitoring market functioning, then stress is persistent. Persistent stress forces persistent deleveraging. This is why Wall Street reacts aggressively, because in a leverage-dependent system, funding is the edge of the cliff. The moment you feel it tightening, you step back. And if everyone steps back at once, the market falls. Now let's turn all of this into a usable framework, because you don't need a PhD in fixed income to track a liquidity event. You need a few clean indicators and a disciplined mindset. First, understand what type of event you're watching. Liquidity event or fundamental event? A fundamental event changes long-term cash flows or default risk. A liquidity event changes the ability to finance positions. Liquidity events are faster, more violent, and more correlated. They are also the moments when it shouldn't be moving like this becomes reality. Second, use a 4-signal dashboard. Signal 1, repo rates and persistence. Not just the spike, but how long it lasts. A brief spike can be technical. A sustained elevation is a warning. Signal 2, Treasury market liquidity. Watch bid-ask spreads and market depth. If Treasuries become hard to trade smoothly, that is a system problem. Signal 3, dollar strength and global funding stress. A strong dollar during repo stress often signals a scramble for dollars. When the world wants dollars, liquidity is tight. Signal 4, Federal Reserve operations and language. Watch whether the Fed increases repo operations, expands reserves, or shifts its messaging toward market functioning. Operations matter more than speeches. Third, recognize how market behavior changes under funding stress. Liquidity becomes selective, spreads widen. Stop cascades become more common. Volatility rises. If you're trading, you must respect that the market's character has shifted. If you're investing, you must accept that the path may be ugly, even if the long-term thesis remains. Fourth, don't confuse a policy response with an immediate resolution. The Fed can ease stress, but it can take time for confidence to return. And if the underlying issue is structural, like persistent reserve scarcity or heavy collateral supply, the stress can recur. Recurring stress is what breaks complacency. Now, let's end with the clean summary. Liquidity vanishing is not a metaphor. It is a repricing of cash and balance sheet. Repo market stress spiking again suggests the system is paying more to fund itself, or struggling to obtain funding on normal terms. That tightness forces deleveraging, which can drive volatility across treasuries, credit, equities, and hard assets. The most important thing you can do in a moment like this is stop looking for a single headline explanation and start watching the plumbing. Watch repo persistence. Watch Treasury liquidity. Watch the dollar. Watch the Fed's actions. Those signals will tell you whether the crack is sealing or spreading. And one final perspective to keep you grounded. Markets can tolerate almost any narrative. They cannot tolerate a funding shortage. When funding tightens, everything else becomes negotiable. That is why repo matters. That is why Wall Street cares. And that is why a repo spike is never just a number. It's a warning from the system itself.